Well, again, good morning to everyone. This is David Moore of IRA Advantage. And today's webinar is titled Tap into Your IRA Funds at Any Age, Purchase Real Estate Today. We've got this side of our business, the 1031 side of the business, Equity Advantage, has been very, very busy this fall. And the IRA side has been pretty slow, honestly. And this last month, it's really changed. So I think what's happening, everybody's in anticipation of the potential change in the person sitting in the White House and the tax rules that might be coming out, tax changes. And just a couple I'd like to mention real quick before we get in this. If Mr. Biden's certified and becomes president, need everybody to be aware that we have his initial tax proposals. They were pre-COVID, so maybe they will be changed, but there was elimination of the stepped-up basis, which would be a devastating thing for a lot of people. As far as what we're talking about there is, upon somebody's passing, all the let's say real estate, for example, would receive a stepped-up basis. Your family will inherit those properties at a stepped-up basis, current market value, and they could turn around the next day and sell with no tax consequence. But the main thing is it really is going to be painful trying to pass assets from one generation to the next. The other issue is potential doubling of capital gains taxes, which again is going to be very, very hard for people in the real estate world. I mean, the qualified money in IRAs and 401k plans like we're talking about today, if you look at Wall Street, we've got tens of trillions of dollars in qualified money there that has this automatic rollover. If 1031 ends up being, well, the third proposal is 1031 be either eliminated or modified to a point where anybody that makes more than $400,000 would be unable to use a 1031 exchange. And I really feel like politicians are sort of separating us and saying, okay, hey, why it's not going to impact me. I don't make that much. But you think about what'll happen. Anybody selling a house, on the West Coast, for example, and even the universal exclusion, you look at 250 and 500 as the exclusion numbers there. I mean, how many people have gains well beyond that, to be looking at, ultimately possibly twice the capital gains tax rate with no ability to do 1031. Or like I said, that 400,000 number, what do you when you sell an asset, that gain is going to be put on top of what you made in a given year, and you might not make anything. And you've got all of a sudden this tax hit on the disposition of this asset. So, we're going to be, if you're interested in staying on top of this, if you're a real estate professional, you probably really need to be aware of what's going on there. Sign up for our newsletters. We'll be getting information out as it comes out. But today we're talking about IRAs and 401k plans. There's nothing out there on the radar anyway at this point that would hinder what we're doing in that space. So once again, I'm David Moore. IRA Advantage was founded about a dozen years ago to accommodate, honestly, our 1031 clients' desires to use qualified money to go buy real estate or make loans, buy notes. And this is not new. It's been possible since the beginning of retirement accounts in the mid-70s. So it's not something that's new. It's not something gray. It's something that's been there for a long time. And we've got many, many successful stories to tell. But the bottom line is you've worked hard for your money. We're going to work hard to keep it yours. And when we're looking at these accounts, think of it this way. You've got the ability to own everything you currently own and anything else the law allows with a self-directed account. So there's no reason not to have one, because it's not going to prohibit what you've already got. It's just going to enhance that with more. So we'll talk about different strategies. And if we're talking about IRAs, we might have suggest different accounts. If we're talking about 401k plans, we're probably going to shove everything into it and go do things from there. But we've got a good hour's worth of information. We probably are not going to address questions during the presentation. If you've got questions, please take note on the right side there. You can post questions. We'll address those after the presentation, get them back out to you electronically. And the only dumb question is the one you don't ask, right? So, our objective here is to teach you what you can and can't do and how to do it. So we'll talk about everything from creation of accounts to, buying and selling property, let's say, and what's involved. We'll even talk about business startups, talk about why people are doing it, some of the objections that come up. But, look forward to anything you've got comment-wise. Please don't hesitate to let us know. And one other thing, we do a lot of work with our video libraries on an Ask the Experts level. And so if you've got something you've got questions on, you'd like to see us put either a presentation together or a video on it, please let us know that too. You can reach out to Cmoore, C-M-O-O-R-E, at IRAadvantage.net. Once again, Cmoore at IRAadvantage.net, and she'll get stuff to you. Thank you again, and without further ado, here we go. So when we talk about this, and there's so much misunderstanding out there, and a lot of it is because a lot of people call up, you know, if I am standing in front of a room, remember that when I could actually be in front of a group of people, I miss your smiling faces and the interaction of being there personally, but at least with this format, we can reach people all over the country very, very easily, or all over the world. But, you know, the bottom line is a lot of people, if I asked a room, you know, who in the room's got a self-directed IRA or 401k plan, and I'd get, you know, maybe if there was 50 people in there, I'd get, you know, 10 that said, oh yeah, I've got these things. And I'd ask, okay, well, who's the custodian, or who's the trustee, administrator of these things? And, you know, they would not have what we would deem a truly self-directed account. They'd have an account that, you know, allowed them to buy whatever was on the menu list of that sponsor or custodian or you know, advisor. But it's not a self-directed account. When we're talking about a truly self-directed account, the term is not a legally defined term. It's a term that describes an account that allows you to go buy anything the law allows. And as I said, this is not something new. It's been there forever. It's just a well-kept secret. And you know, it's something that's time tested. And it's really amazing to me because I've got, once in a while, I get calls from somebody maybe that had timber deeds and things in their account, and maybe they were in the logging industry years ago, and you know, maybe in the late 70s they put these accounts together, and then you know, they get a call from the custodian that they no longer want to offer, you know, that type of investment, so then we'll have to move them to another custodian. But if you look at this, is not a difficult thing. It's very, very easy to do. And it really, if we're talking about putting a self-directed IRA account, for the most part, we're just moving money from a custodian that won't allow you to do what you know, what make that investment you desire, to one that does. That's as easy as it is. If you've got an IRA today and you say, gee, I'd like to, you know, make loans with it, or buy notes, or buy crypto even, you know, we've got a fair number of people that want to do that these days. Obviously, heavy, you know, precious metals are something that's popular today, tangible assets, inflationary hedges, and something that's going to be there to, you know, protect people if there is a crash of the economy. You know, those things, a truly self-directed account is going to allow you to do those things, and in some cases actually take physical custody of those items too. So when we're talking about a truly self-directed account, we're talking about an account that will allow you to own everything you already have and everything else you'd like to within the law. And if there's a restriction on you at this point in time that would prohibit you from, let's say, taking money and going out and buying gold or buying a piece of property, that restriction, once again, is not by law, it's by that custodian, or if it's a 401k plan, it's by that plan. So we're going to look at, if it's an IRA, you know, we're, like I said, we're going to move from one custodian that doesn't allow you to do what you want to one that does. If we're talking about 401k plans, we're going to read the plan, and you'd be shocked at how often, you know, I'm working with a client or potential client calls up, says, hey, you know, I'd like to take my 401k plan to go do this or that. And they've been told they can't do it. And I get a copy of the plan, read through the plan document, and it clearly says they can. So I actually had one occasion where I'm dealing with an ex-IRS auditor who's a CPA and a real estate broker. And, you know, he's a good friend, and we've done a lot of 1031 work for him through the years. He wanted to make an investment into a tenancy in common apartment complex. And, you know, he was told his plan would not allow that to happen. And, you know, so I reviewed the plan, found that it did, and I literally got in an argument with the administrator about what he could or couldn't do. And I pointed point blank the statement in that plan document that said he could do it. And finally, after a day's going back and forth, in this situation where I gave the administrator choice, I said, look, you know, you can help your client get him where he wants to go, and it's in his best interest and your best interest to do it. Or if you say no, we're just going to move his money, and you're going to lose the plan, lose the client, and have somebody unhappy with what's going on. And that's ultimately, what happened, because finally, after I convinced him to talk to his legal counsel, and they said yes, they would make the investment, but they needed a week to analyze that investment. That was going to be too long, couldn't get the thing done, so we ended up moving it. But that was, just one example of people not really understanding what their plan document says. And I'm not talking about the investor in this situation. I'm talking about the, trustees and administrators of the actual plan. So, when we look at a 401k plan, if there's a restriction that would prohibit a person's desired investment, we're going to say, okay, can we amend the plan to allow that? If we can't amend it, we might replace the plan. So when we're looking at these transactions and what people are wanting to do, the first thing we're going to look at is what kind of account you have and what you want to do with it. And, when I'm looking at these transactions too, if I'm looking at a 1031 exchange, I've got 4 basic issues I've got to deal with. One, it's got to be an exchange. Something's given away and received. 2, what's given and received have to be of like kind. 3, we've got to go across or up in value and equity. We call that the napkin test. And 4, we've got to have continuity of vesting. Really, I break it down. Time issues are the biggest with a 1031. Vesting is also there. But we're looking at those 4 cornerstones. If I look at a retirement account, I've got 2. It's not complicated. I've got 2 issues. What does my client want to buy? And the way the law works in this space, if it's not specifically prohibited, it's therefore allowed. 2, who are they transacting between or for the benefit of? Any transaction between or for the benefit of a disqualified party, which we'll talk about a little bit later, would constitute a prohibited transaction. That's an absolute no-no. A prohibited transaction with an IRA means complete distribution of all funds in the account as of the first day in the year in which the indiscretion occurred. You do not want to do that. 401k plan, much, much more forgiving. A 401k plan is just going to encumber the funds involved with the indiscretion. And, that's a totally different, situation there. But, the idea is we're going to look at where you are today and, what you want to be, where you want to be in 2, 5, or 10 years. We're going to look at the accounts you've got, what we can do with those, and we're going to work our best to get you where you want to go, you and or your clients. So when can I create a self-directed IRA? Okay, any IRA can be self-directed. There's a slide we're going to cover real quickly, talks about that. When we're talking about 401k plans, we've got a different situation. If you're happily employed under 59 and a half and the funds you've got are in a current corporate plan, you're not going to have access to those. When you hit 59 and a half, you can get access to it. That's called in-service distribution. We're going to roll. It's not all or nothing either. You can move what you want to use in this capacity. Remember that. It's not all or nothing. And we'll talk about that more when we're talking about funding the IRAs and what we're doing there and how to protect them. But when we're looking at these things, with COVID, we've got lots of people that have been displaced maybe for work. And if you're under 59 and a half and you've changed jobs or you're in the process of changing jobs and you still got that previous employer plan, you cease to be employed, you get access to that money. So at that point, we can roll those funds into whatever you want to do. If it's an IRA, if you're going to go become self-employed, we'll probably do a solo 401k. If you want to go out and create a new business, which we'll talk about, something called the rollover business startup or ROBS. I mean, we can literally start a new career for you. We can create a new business that you're employed by using your retirement funds. So when we're looking at this money, you got to understand when you can get access. Once again, any IRA can be self-directed. If it's a current plan and you're under 59 and a half, you're going to be stuck until you're 59 and a half. If you've changed jobs or right now you're unemployed, you've got access to that money. This is the time you ought to do it. I've got about a year ago, we brought somebody new into the company, and she was interested in rolling her plan into our plan. And I said, don't do that. Why don't you just go and we'll put it, self-directed IRA, or just put the money into an IRA instead. And then you've got control of it. If you move it into our plan, now it's stuck with us until you turn 59 and a half or you move jobs once again. So really understand, ask the questions, talk to your financial advisor if things change and see what you can and can't do. So, as I said, when we look at these accounts, 2 issues. What do you want to buy? And who are you transacting between or for the benefit of? It's not that hard to put it together. We're moving, if it's an IRA, from a custodian won't allow you to do what you want to one that does. If we're talking about 401k plans, if you're entitled to get access to money, we're just going to simply look at replacing the one plan with another plan. And the plan that we put together is going to allow you to buy anything the law allows. This is not difficult. Typically it's going to take 2 to 4 weeks to do it. But like most things in life, you ought to plan ahead. Make sure you're ready to go when you make that investment. We advertise on the radio, and it's really amazing how people will call up, ask questions, and we'll really say, look, you need to have this thing set up before you go find a property or something. And inevitably, what happens is our client will find a property, all of a sudden they've got to buy it, and they want to write the offer before it's ready to go. So just a simple bit of investment advice right now. If you don't have the account set up and you find a property to buy, or if you're a broker on this call and you're selling to somebody that's got a retirement account, as a broker, you want to know, number one, is the account ready to make the investment? And two, what kind of account do they have? If it's not ready, it's going to take 2 to 4 weeks to put it together. Now, you're probably going to need earnest money, and who do you even write the offer between at that point? You can't tie it up personally and then sign it over the plan. That would constitute a prohibited transaction. So you can see there's minefields out there, and I guess that's something that I would say right at the beginning of this talk also is these are not right for everybody. You've got to understand that if you've got a self-directed IRA, or 401k plan, many of our people have checkbook IRAs or solo 401ks. They've got the power of the pen. You've got to be diligent to make sure that you're not doing things that would be considered a prohibited transaction, because you do have the opportunity to do that. If you've got let's say a Wall Street IRA, it's possible for you to make a bad investment, but it's really pretty much impossible for you to commit a prohibited transaction. So, as I said, when we're moving money from the Wall Street world into an account that allows you to own everything you currently have in Wall Street plus everything else, we've got a certain level of responsibility there. You've got to be smart what you're doing. Keep an eye on it, because you could commit a prohibited transaction as simply as tying up a property with a purchase sale agreement personally and wanting to sign that over to the plan. Now, I know most PSAs, purchase sale agreements, are signable, but that assignment from you personally to the plan would constitute a prohibited transaction. So it's really important that we get these things put together before you go shopping, because inevitably you're going to find something you're excited about, and then you're going to need the money, and it takes time to get it together. And once again, if you're a broker, you want to make sure that who you're working with is ready to go when you find them that property that's going to fit their needs. So why do this today? Well, we talked a little bit about it. I mean, part of it is just that you might have a situation right now where you've had a job change or something, or maybe you're just needing to help out on some other assets. Maybe you want to take advantage of some tangible assets. We all hear and see the ads for precious metals on TV and the radio all the time. And our accounts are going to allow you to buy any of that stuff. And if you're talking solo 401ks and checkbook IRAs, you can literally take and buy a safe and put the stuff in it. But if you've got a basic self-directed IRA, you're going to have a dispensary depository that's going to actually take care of that investment for you. But why do they do it today? People are concerned. I mean, Wall Street is, you're talking liquid investments, and Wall Street will look at real estate and say, well, the problem with real estate is it's not liquid. Well, liquid investments have a tendency to go up and down a lot. I mean, look at the stock market day in, day out, and everybody's told not to buy or sell on news, but what happens every day? That's what happens. Real estate, once again, you've got a much more, let's say, stable asset, and it doesn't go up and down as wildly as Wall Street. But you've got to make sure you've got enough where you need it to take care of your investments during the investment life. So, we will say that if you're going to go out and buy real estate, if the investment's going to take $100,000, you don't want to put $5,000 in the custodial account to do it. You want to make sure you've got enough to make the investment, cover any potential shortfalls during the holding period. You know, a lot of times we're talking about cash flow properties. You're going to be piling up funds in the account as rent payments are made. But you know, let's say it's land, something else where you don't have that income. You need to make sure you've got enough to make the investment and cover all carrying costs during the anticipated hold period. So, tired of the stock market's roller coaster, greater financial control, invest in what you know. Now that one's interesting because think about Wall Street. I'm not the biggest fan of Martha Stewart, but she's not the biggest culprit of insider trading. Okay, she was just sort of made an example of, and that's just dead wrong. But on Wall Street, you're not supposed to, not supposed to take advantage of inside knowledge. Real estate or a self-directed account, buying real estate, all that's fine. If you're a mortgage broker, you want to take your retirement account to go make loans to people, that's fine, or buy notes. Hey, I hope you have an advantage in that situation. Why not do that? Why not use your knowledge to help you get where you want to go, reduce the risk? If you're a real estate broker or builder developer, any of those, I would anticipate you have some information or knowledge that is proprietary to you and your company that will help you make good, solid investments. Why not self-direct a piece of it? It's just a question of diversification, really. And what's interesting is if you talk to a normal let's say you go talk to your financial advisor, so often he or she's just going to say, if you say, look, I'd like to go buy some real estate, they're going to say, okay, let's go invest in a REIT. Well, REIT's not really real estate. I mean, the REIT owns real estate, but you don't get the benefits of ownership of real estate. So it's a stock. If you want to go out and actually buy a piece of property, it's going to require a truly self-directed retirement account. And let me mention this, diversification, it's just diversification, all right? And if you look at retirement funds and how much of that money is actually in real estate, the last numbers I saw was about 2% of it. That's not very diversified. So why not take a piece of it, further diversify, go get yourself some gold today if that's what you think is going to help you, survive what may be coming. Go buy some real estate, maybe buy a note. The idea with the note is never anything but a first and never more than you'd be happy owning the property for. Don't do the seconds, they're worth the paper they're written on. That's about it. But, keep an eye on that stuff. We talk about real investments, not alternative investments. Now that statement is sort of my bone with this whole process because it's really interesting to me if you talk to financial people, investment people, and you talk about real estate's considered an alternative investment, as is gold. Now, can anybody out there tell me an investment that's older than real estate or gold? I mean, I can't think of any, maybe some type of stones or something, but those things are the oldest, most time-tested investments in the history of mankind, and yet in the investment world, they're considered alternative investments. And that just, to me, it makes it sound like they're lesser. And if anything, they are tangible assets. They're real. They're not going to go away. If you own a piece of real estate outright, the only way it's going to go away is if you just don't pay property taxes on it. And it's going to take years for you to lose it. I mean, it's just not going to go away. It can go up and down in value. Gold's the same way. The only way it's going to go away is somebody steals it from you, I guess. But the idea is, once again, we're looking at a situation where it's going to be there. It can't go away. Any stock can go up, it can go down. But anyway, tangible assets, hard assets, they're here. Community-based investment. You invest locally and help people out in your community, you can do that. You see an opportunity, go invest in, let's say we all know restaurateurs that are having a hard time right now. Maybe you've got somebody that that needs some help and you'd like to help them out. Well, you can make a loan with the retirement account. You could actually buy into the restaurant with that retirement account. You can do whatever, whatever is going to fit within the law with respect to IRA and 401k investments. But all of those things are possible. So you can make a difference in your community if that's what you are all about. Today, take advantage of today's opportunities. Well, what's a great opportunity today? I mean, the stock market's going crazy, real estate's going crazy, everything's sort of going crazy. If I've got clients on the 1031 side that are not being paid, they've got multifamily projects, they're not being paid because some politician has basically stated that the tenants don't have to pay until next year because of COVID. Well, Nobody's telling the banks to sit back and let that property float along. So these property owners are having problems. And you know, if that tenant doesn't have the money to pay today, are they going to have the money to pay, you know, let's say first quarter next year, second quarter next year? I would doubt it. So, you know, we might not have some of the real opportunities in real estate probably are going to be coming up second quarter next year, third quarter. But, you know, who knows? You know, I thought I knew a lot more than I did. I've been doing tax deferred exchanges for 30 years. And, you know, here we go. You know, we're sitting in a situation where once again, yet again, I've got to defend 1031 and, you know, keep it going. And, you know, we've got these rates going back and forth, but you've got to use the laws as they exist today. We don't know what's going on tomorrow, but taking advantage of today's opportunities, you might have a situation where you want to diversify, or maybe you see opportunities elsewhere, but, you know, opportunities, it's all timing with these investments. So take advantage of the opportunities when they are going to appear, and be ready to do it. Security, like I said, things going away, new business, we're going to talk about that with the rollover business startup. So possible investments. An IRA can buy literally anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. You know, you're probably not wanting to do those things anyway. So with an IRA, I mean, unless it's specifically prohibited, it's therefore allowed. And those are the restrictions. So any investment must simply be for investment purposes. 401k plans, on the other hand, the only restriction is collectibles. So they're even more liberal with respect to what you can and can't do. So you name it, one of these accounts can own it. And once again, I want to stress that our self-directed accounts are going to allow you to own anything your account currently owns and everything else the law allows. So you're not going to lose the opportunity to invest in what you've got going on. If we're talking about IRAs, I probably, if we're looking at moving a piece of the portfolio or a piece of that IRA into the self-directed world, what I'm going to encourage you to do is keep the Wall Street stuff with your current custodian and advisor. Move what you want to use in the self-directed world into the new self-directed account. And the reason I would segregate the two is, by keeping the Wall Street stuff at Wall Street, it's isolated from your self-directed efforts. And the self-directed efforts, you know, once again, you do have the opportunity, if you screw up, to commit a prohibited transaction on the other side. So I think it's a great idea to have those two accounts separate. The easiest way to have the Wall Street stuff, if you're going to move all of it in the self-directed account, the easiest way is to just open a trading account in the CHECKBOOK IRA LLC's LLC name and EIN, and just do it that way. It's easy to move funds back and forth, but by doing it that way, you have not isolated those two sources of investments. So once again, in life, it always seems like the best way to do something is the hardest way to do it. And if we're looking at checkbook IRAs, most of the time our people are buying real estate that's piling up at, you know, capital in the CHECKBOOK IRA LLC as rent payments come in. And then every so often, since banks are paying us next to nothing today, and threats of going to negative interest, that people just can't afford to have the money sitting in a bank account doing nothing. So they'll have to move the money back from the LLC through the custodian back to the Wall Street custodian. So, you know, we're going to look at, once again, what people have, what they want to do with it. We're going to direct you, you know, give some direction on what's going to be the best possible vehicle to get you where you need to go, and how to be, you know, protected the best you can. So I said there's two issues. You know, what do you want to buy? We talked about that. The second part was, you know, any transaction between or for the benefit of disqualified party would constitute a prohibited transaction. So, you know, who are you buying from, selling to, loaning to, borrowing from? You know, are you going to buy a rental house and put a kid in it, which is not okay? You could put a sibling in it, which is really strange. But anyway, so who's a disqualified party? A disqualified party to your plan would be you. If you're married, your spouse, parents, grandparents, kids, grandkids, their spouses, or any legal entity owned in a controlling interest by one of those parties. Now, if you look at the bottom of this page, in bold it says, please note, siblings, aunts, uncles, cousins are not disqualified parties. So once again, I want to stress, they are not disqualified parties. So if you want to loan a sibling money, that's fine. You want to buy them a place to live, That's fine. You want to buy something they have? That's fine. You want to sell something to them? That's fine. You want to have them work on a property. Sweat equity is not okay. You, as the IRA owner or 401k plan owner, you cannot work. Sweat equity is not okay on a property. You cannot go and work on these assets. You can do the administrative functions of management, but you can't get dirty on it. So, you could have a sibling do that work. You could not have any of those other disqualified parties do anything there or benefit in any way. So, what's interesting is you can't transact between or for the benefit of the disqualified party. You can transact along with, and we'll talk about that a little bit more in a few minutes. So once again, what are you buying? 2, who are you transacting between or for the benefit of? That's all there is. Don't let it get more, confusing than it needs to be, all right? So if we're talking about real estate, what can you buy? Rental houses, apartment buildings, office buildings, retail centers, land, any real property to be held for investment. How about a future retirement home? Yes, that is totally fine. If we're talking about a retirement home, you can't use it until it's been taken fully as a distribution. So when we're looking at buying something that you want to retire into using traditional IRA funds or solo or a 401k, what we're going to do is make the investment. During the time it's held by the plan or held by that IRA account, you cannot commit any prohibited transaction on it. Can't use it in any way, nor could any other disqualified party use it. Now, how do you end up getting it? Well, you take pieces of it, or you take the property as a distribution. I started to say pieces because ideally that's the way that I would do it, and we'll talk about that more in a few minutes on how to minimize the tax consequence on distributions. But the idea is, as soon as you've taken the property as a distribution, it's yours to use. If you take pieces of it, there's some real tax opportunities there. What can't you buy? Primary residence, second home, home for disqualified parties. So, let's say junior goes to college and want to buy a property using your retirement account for him to live in during the time he's going to college. Cannot do that. Your kid's a disqualified party to your plan. You cannot do that. And by the way, one other issue there with disqualified parties is you've got a traditional IRA and a Roth IRA. Those two accounts are also disqualified parties to one another. So, we really need to look at this stuff and understand what you have and what you want to do with it. And we're going to structure what's needed to get you there. The office building to be used by a disqualified party. A lot of times we have doctors or lawyers call up and they want to, take their retirement accounts and go buy the building that they ultimately will occupy, and we cannot do that. That would constitute a prohibited transaction. Common objections. Okay, let's say you go out and you decide you want to do this. So you go and talk to your tax people, your legal people, or your financial advisor, and they say, oh, you shouldn't do that. And these are the typical objections we get, all right? One of them is, like I said, the objection to real estate. They'll want to buy, shove you into a REIT or something. That's not really owning real estate. But, I'm going to stress, keep what you want in the Wall Street world with that account, and then move what you want to use in this space into this account. Let the cash flow and all as it piles up, then move it back in the Wall Street world if that's what you want to do with it. But we're looking at common objections here. Typically people say, well, okay, gee, and this is a true story. I was at a presentation that a Tennessee Common company was offering one night, and they had an economist speak, they had a CPA speak, and they had one of their investment people speak. And I went up, they talked about 1031s, they talked about some other stuff, and I went in and after the presentation was over and talked to the CPA about what's going on, and said, hey, nice job on it, talked about the exchange stuff, talked about the retirement account. So he says, oh, what are you doing? I told him. And he says, well, I don't think it's a good idea to take your retirement money and put it into real estate. And this same thing happened. It was really interesting at a Federation Exchange Combinators meeting in New Orleans a year ago. As CPA from Florida, I had a conversation, middle of the night in New Orleans, so you can imagine what's going on there, but the idea was, once again, he was going, oh, why would you do that? And that loss of long-term capital gains tax rates, that's just a pointless statement, because there's nothing that you buy with an IRA or 401k plan that's going to get you long-term capital gains tax rates. If you want to tell me, hey, you're better off to buy a piece of property personally instead of inside a plan or instead of inside an IRA, I will agree with you, because you've got interest deductions, depreciation, the cash flow, you can work on it. End of the day, you do a 1031, kicking the tax liability down the street. So yes, I mean, if you can only make an investment with one source or the other, I'm going to tell you, take the money out of your pocket. But that's not what we're talking about. We're talking about investments and diversification, and we're just looking at what you want to do with this, and that's what's important. So if you want to diversify into this stuff, into the real estate, the tax consequence of pulling that property out is very advantageous. If we start talking about in-kind distributions versus cash distributions, it can be very, very attractive. But if we look at long-term capital gains tax rates, nothing you buy with an IRA 401k plan is going to get that, so that point is not a point. Cannot be leveraged. Totally wrong. If we're talking about using an IRA 401k plan to go buy real estate, it must be non-recourse debt. And in a nutshell, that just means that the loan's not attributable to you, your income, your credit, or anything else. It's going to be a lower loan to value, and they're going to want to see reserves, and they probably are going to want to see a borrower that's got some history with real estate. Because the deal is, if something happens with the property, you've got to make sure you've got enough money in there to take care of the acquisition, and once again, all the carrying costs during the anticipated hold. So the fact that the statements made cannot be leveraged, totally wrong. It's just got to be non-recourse IRA 401k compliant debt. What about RMDs? Now, since that real estate's not liquid, let's say you hit the 72 number. By the way, for people out there, if you didn't know, your RMD age went from 70 and a half to 72. So 72 years old is now where you have to take money out of your retirement account. So let's say that you get to that RMD age and year's end comes and you've got property, and for some reason all the money's there, you don't have enough money to take a distribution. You don't have the cash in the account to take that required minimum distribution. What do you do? And the Wall Street world says, oh, that's this huge problem. Well, no, it's not. You just take a piece of that property as a distribution. That piece could be either a tenancy in common interest, or if the property is owned by a limited liability company, we just do an assignment of membership interest to satisfy that RMD. Now, not only is this not a problem, but I believe it's a huge opportunity. Number one, what's that distribution worth? Two, whatever it's worth, if you're taking a minority interest, if you take an entire property as a distribution, what you're taking is the equity in the property. All right, so you're going to pay tax on any of the equity that comes out. If we take an in-kind distribution and we take the whole thing out, boom, you have tax on the entire equity in that thing. If we take a piece, a minority interest distribution, we can actually discount the value of that distribution by up to 40%. Now, this process is, once again, not new. It's typically used in estate planning circles when we're looking at gifting, and the same rules apply. So we're just going to take that strategy, and instead of using it for gifting, we're going to use it for RMDs. Now, if you take an in-kind distribution, as I said, you've got a couple big benefits, beneficial opportunities there. There's always a downside. There's a good and a bad to everything. So what's the downside? Well, you're taking and incurring a tax liability on that distribution without receiving the cash to pay the obligation. So how do we get around that? Well, a lot of our clients will take the property out, do a cash out refi of the property after they've taken it out, and now they pay the tax obligation with the refi funds out of the assets, so they haven't had to come out of pocket any money. And once again, if you've got any questions on any of these items or anything else that comes to mind, please reach out, email us, give us a call preferably, because we can have a 5-minute conversation that will take care of days worth of emails or texts. So don't be afraid to pick up the phone and call. There's no cost or obligation to that. The final bullet down there: lose interest deductions, depreciation. I apologize, it looks like the frame is sort of our little logos covering up part of that statement. But if we look at interest deductions, depreciation, yeah, that's true. But once again, what else is going to have that benefit inside a retirement account? Nothing really. And it is possible if you're taking and you know, looking at a situation where you have a leveraged investment with an IRA. You know, what's interesting, IRAs with the leverage, you're going to have tax exposure on any income or gain attributable to the leverage. So if you've got a property that's 50% loan to value, half the income is going to have tax exposure and half the gain on disposition. So pay the property off before you relinquish it. 401k plans, you don't have that. So that's a big, big difference there. But if you've got an IRA, you may be in a situation where you need to take, and your tax people will take interest deductions, depreciation to mitigate any actual tax exposure. And that income or gain component of a leveraged investment is called UBIT or UBTI, unrelated business taxable income. So how do we create these things? So if we're looking at, you know, rollovers from corporate plans, you've got to be 59 and a half years old, as we said at the beginning, or you've got a situation where it's a previous employer plan, then you can get access to those funds. We just move it into whatever we're going to do. So, you know, we can work with any of these, this variety of plans to do that for you. And, you know, just got to see what kind of account it is, see what age you are, and see whether we could get access to it. Any IRA can be self-directed. So we have absolutely no restrictions there. Actually, one comment, if we're looking at moving, let's say a beneficiary IRA, one that's been inherited, or Roth IRA funds, we cannot move either one of those into a new 401k plan, but we can create a self-directed IRA with, you know, both of those without any issue. So how do we do it? Well, at the beginning, remember I talked about how easy it was? So when we're looking at these things, really, you're just in a situation where we're going to have you fill out an application. If it's a basic account, we're not the custodian. The reason we're not the custodian is the custodians we use charge our clients a couple $100 a year to be custodian. We're not going to put a bank together, a trust company together to handle that. So just as we occupy, you know, the space between what you don't want and what you do want in the tax world with Equity Advantage via 1031 exchange, we are an IRA 401k facilitation company. We're going to take a look at where you are, where you want to go, and figure out what kind of investment vehicle is going to fit your needs best and create the investment structure that's necessary. But if we're looking at a basic account, all you're going to do is fill out an application, establish a custodial account. And one of the forms that's actually filled out when we get involved is a transfer authorization form, which allows the new custodian to go to the old custodian and say, give me the money. And that transfer happens very easily. As soon as the money hits the account, it's ready to go. And you know, basic accounts, you know, what happens there is every investment's got to be submitted to the custodian, approved by the custodian, and then funded by the custodian. And the custodian's actually the legal owner of whatever it's purchased. If it's a piece of property, the trust company is going to be the deeded owner. And you know, the taxpayer, they're going to be the deeded owner for, and it's going to read the trust company, CFBO, custodian for benefit of, IRA number, da 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 da, you know, and then your name. And that's what that deed's going to look like. And that's it. If there's insurance policy, that's going to be written up. If it's going to be a purchase agreement, that's who you're writing the agreement between, so on and so forth. But that's a basic account. All right. A checkbook IRA is what most everybody that buys real estate. So let me qualify that. A basic self-directed IRA is going to be good for a single, you know, infrequent investment that's not time sensitive and that does not require any management. All right. If you want to buy a property, manage it, or you want to buy properties at auction, or you want to you know, do things that, you know, maybe you're building something, having people build something, you're going to want a checkbook IRA, you're going to want a solo 401k, you're going to want the power of the pen. So if we look at the bubbles on the far left of the screen, it shows IRA, 401k, Roth, whatever it is, we're going to create the necessary custodial account for each of those accounts. And then after that custodial account is established and funded, instead of the custodian buying the piece of property directly or whatever it might be, the custodian's only involved with one investment. The investment they make is into the new checkbook IRA LLC. So if we look at that checkbook IRA LLC, its member is going to be the trust company for benefit of your IRA. You are the manager of that limited liability company. So as soon as we've completed, and that limited liability company contains an IRA-specific operating agreement, it's critical it's done right. The custodians will not accept a regular operating agreement. They just don't work. You're going to have a big problem. So make sure that whoever's going to do the IRA LLC, they need to know what they're doing. They need to be in this space. Otherwise, you're going to spend a lot of money on things going back and forth. About 5 years ago, we had a client that was a very successful business person, and she didn't want to pay, just for the sake of the conversation, you can put a basic account together for a couple $100. The checkbook IRA, we charge about $2,300. These fees are paid by the account typically. 401k plans, we charge about the same amount of money, but she didn't want to pay the additional money, the extra, couple $1,000s for the checkbook IRA. So we just put the basic account together. I said, hey, you're not going to like this. You're not going to be happy with it. And sure enough, when she went to make the investments, she was really struggling with how it was to be done, and just didn't like how cumbersome it was. So she contacted her lawyer and asked him to put the LLC together, which he did. And the bottom line is he didn't know how to do it, and $10,000 later she had a limited liability company that did not work, and guess who she called? So we ended up putting it together. So don't, it's really important. Good tax and legal people are critical to any investor's success, and I'm going to say that whether we're talking about real estate 1031s or retirement accounts, whatever it is, you want good people. They're good tax people are some of the most important people in your life. So get good people in your life. I know it's not cheap to do that, but more often than not, they're going to more than pay for themselves taking care of you. So in this situation, what will happen with a checkbook IRA, the custodian's involved with one investment into the limited liability company, and that limited liability company has a bank account at the bank of your choice. You've got an account in the limited liability company's name and federal tax ID number. You as manager have the power of the pen. So as soon as you've got the custodial account open, or not the custodial account open, I'm sorry, the bank account open in the LLC's name and EIN, get that information to us. We're then going to submit the investment to the trust company. They're going to make the investment in the LLC funding the bank account. And from that point on, whatever you want to buy, you're just going to write an offer between the seller and the limited liability company. You as manager can write a check if it's real estate to make that earnest money payment. When it comes time to buy, you write a check. All the income from that property is going to go into the LLC. Any expenses are going to be paid out of that LLC. During the time you own it. When you sell the property, once again, you just list the property between the broker and that limited liability company. The proceeds from the sale come in and sit there until you make the next investment. The real beauty of it is, anybody out there that's on this call that's done a 1031 exchange, time is a big headache. You got a 45-day ID period to find what you want, a total of 180 days to get it done. In this world, the money goes back to the account, sits there until you make the investment. It could be tomorrow, it could be a year from now, it could be never. But you do it as you choose. You make the investment that you want, when you want, as you want, and that's a pretty wonderful thing. Oh, one last comment on this. We can include in that limited liability company, that LLC can combine any number of entities or people. And you could be a member personally. So if let's say you've got $200,000 retirement account, you need $300,000 to make the investment. Well, you've got two choices. You can make the investment tenancy in common with your checkbook IRA LLC, which I like that structure because when you go to sell the property in 5 years, you personally can do an exchange, and the LLC then is going to have the qualified money just go back into it. So that's a nice option if you're looking at gains through time and moving things in and out, or you can be an additional member of the limited liability company. Or we can combine, let's say you're married and you and your spouse each have retirement accounts and you'd like to combine them into the one LLC, we can do that. You can combine tax money and qualified money. You can combine Roth funds and traditional IRA funds. You can, it can include IRA funds and 401k funds, but that LLC can contain any number of members, even if they're disqualified members. If we have disqualified members in that limited liability company, we need to overfund the investment into the LLC because we cannot add money to the limited liability company after the initial funding if we have a multi-member LLC with disqualified parties as its members. So if we have a group of non-disqualified parties in there, we can always add money, move money in and out, but we cannot move money into that LLC as additional investment funds from any disqualified source in the future if it contains disqualified parties. The investment yield is going to go in and out of that LLC, no problem. We're just talking about adding money. Maybe you're, if you're in your 30s, you've got a long time you're going to make contributions to these retirement accounts. So we'd probably discourage you from structuring it that way. If you're in your 50s or 60s, why not? Because you're probably at that point, you should be more concerned on how you're going to get the money out rather than getting it into the account. So how about a solo 401k? Anybody out there, if you're a real estate broker or anyone else that's self-employed without full-time employees, I'm going to shove you into a 401k plan instead of an IRA. I just like them better. They cost about the same to put together. The carrying costs are much less. A checkbook IRA, just so you're aware, has carrying costs after the initial setup. You can look at the custodial fee is going to be a couple $100, state registration fee for the limited liability company, registered agency fees, and then the custodian that we primarily use requires a third-party review of the LLC's activities annually. That review can be done by your tax or legal counselor. You can have us do it as the organizer. If you want us to do it, we're going to charge you a couple $100. But you're not, after we've created this thing, you're not paying us anything unless you want us to do the reviews and or be the registered agent for the LLC. So, we've got a one-time fee that's set up on the setup fee. After that, unless you want us to do the reviews or the registered agency, you're not going to be paying us anything. The 401k plan, you really, all you've got after the initial setup is annual amendments or restatements, and they're about $300. So that's really nothing. Where a checkbook IRA, you're probably talking $500 to $700 a year to keep it going. And a lot of people say, well, gee, that's a lot of money. Well, you're paying more than that with your current accounts. It's just embedded into everything. So you got to understand, this is it. When you're looking at that checkbook IRA, it's $500 to $700 to keep the thing going. A solo 401k is going to be about $300, and that's it. Now, the reporting for the 401k plan, if you've got more than $250,000 in it, you've got a situation where you fill out a 5500 EZ form, pretty easy thing to do. But the reasons I like these 401k plans, as I said, we can't move beneficiary IRA or Roth money into them. But after you've got the money in it, you can do Roth rollovers inside the plan. You've got your annual contribution is income dependent, but it's up in the mid 50,000 range. So it's the highest you're going to get with any of these things, short of a defined benefit plan. You don't have that UBIT on leverage, which is a big thing. Don't have a custodian, you commit a prohibited transaction. It's just the money involved within discretion instead of full distribution like it is with an IRA. The other thing is you can actually, borrow funds against it, up to 50% of what's in it to a max of $50,000. That number is actually higher right now. There's some COVID relief that kicks it up to 100,000. Talk to your tax people about that. But those are the reasons I like the 401k plans. And a 401k plan, you're just going to have a bank account in the plan's name, NEIN, and you are the trustee of the plan. So once again, it works just like a checkbook IRA. You've got the power of the pen. If you want the additional protection of an LLC, you can just put a basic real estate holding LLC together, and then we'd be happy to take care of that for you too. So examples of prohibited transactions: borrowing money from the IRA, selling property to your IRA, unreasonable compensation for management. I'm going to tell you, don't compensate yourself at all. I don't like that. This is just one of those things, a CYA deal for us, because since sweat equity is not okay, maybe there is an argument that there should be some compensation there. We're going to say there should never be a check or payment either direction between you and your retirement account. Just stay away from it. Don't open up that can of worms as a potential problem. You cannot use your IRA or 401k as security for a loan. Buying property for personal use is a no-no. And like I said, a prohibited transaction is going to treat the entire account as distributed as of the first day in the year in which it was occurred if it's an IRA, and that's not a good thing. Can we get a mortgage? We talked about this. Got to be non-recourse debt. Disqualified party cannot guarantee a loan for an IRA. And you can't say, gee, I'm going to buy the property along with my IRA The IRA component of that loan is going to be non-recourse, and the personal component is recourse. That does not work. If there's a benefit to a disqualified party, that constitutes a prohibited transaction. The only reason the loan was made is they could get their teeth into use. So it's got to be a non-recourse IRA compliant loan. And typically you're looking at maybe at most 60-65% loan to value, and as I said earlier, probably 15% reserves. Cost of money is going to be a little bit more. It's going to be a portfolio lender. An easy place to look for that is myiralender.com or iralending.com. But there's a variety of sources out there, and there's a lot more sources for commercial property than there are residential properties. Contingencies, you're writing an offer. If it's a basic account, one, actually, you got to make sure you're ready to go. Two, we've got to make sure that if this is a basic account making the investment, you've got to include something in there stating that the purchase is subject to the custodian's approval, because the basic account, every investment has to be submitted to the custodian. If there's financing there, you need to make sure that don't rely on the boilerplate financing in the PSA, the purchase sale agreement. Make sure it says something about IRA specific loans. Three, it takes 2 to 4 weeks to put it together. So don't go out there, get excited, make an offer on something and assume you can assign it over to the plan. That constitutes a prohibited transaction. Make sure it's set up and ready to go before you start shopping. Selling the property, we talked about this, list it as you normally would, and listing agreements between the broker and the IRA LLC or IRA custodian or 401k plan. You sell the property as you normally would, the money's just going to go back in the account, and it is ready to go as you are. So business startups, and a lot of these times, during the last crash, we did a lot of these. We're always doing them. We haven't put any together, to the best of my knowledge, in the last month or two, but I would expect going forward we will see them. Really what's happening there, we're going to move whatever type of retirement account you have today into a new 401k plan. We're going to create a C corporation. The plan buys into the corp. We're going to require you personally put 5% of the initial funds in at least. And then that corporation makes the investment into the business, and now you're working for a company owned by your retirement account, or at least partially owned by that retirement account. Very attractive thing, works very well. The last slide I've got is going to talk about a scenario where I just love the story. I always used it. If you've been on my previous webinars, sorry you're going to hear it again, but I just think it's great. So there you go. Couple more slides and we're done. This is a few examples, and then we'll wrap it up. This person came to us. This was a long time ago, early 2000s. We had a situation, obviously, where we had that crash in 07, 08. This is a guy who had a friend doing a real estate development down at the coast, and that guy was unable to sell lots. So he said, hey, I want to move a piece of my retirement account into this new self-directed account and make that investment. It's an opportunity I think is going to be a good investment, and I've got the opportunity to help a friend. So that's what he did. After he made that investment, he started, hearing about other investments our clients were making, and one of the companies we work with had put a project together, up in Boise. It was a student housing project affiliated with BYU. BYU will withhold a kid's diploma, at least they did in those days if they weren't current on rent. Loved that. And this, so he was going to have a tenancy and common interest in that project. And he made that jump, and he just loved it. That was about the best investment I think he ever made. Doubled his money in a very short period of time. And since then, he's rolled it into other things. But a lot of times people sort of dip their toe in the water, get an idea of what they want to do, how it works, and then as they realize, hey, this is something that's more attractive, they'll move more money into it. Now, there is the other side. If we're talking about real estate, it's not easy, right? So we've got some people that put these accounts together, and then they've got, the bottom line is if your Wall Street people make a bad investment, you can get mad at them, but if you're self-directing, typically the buck stops with you. So sometimes we'll put an account together and the responsibility falls back on the taxpayer, and they're in a situation where now they're anxious. So just be ready for what it's going to be and the responsibility that's there. And what's interesting is my IRA 401k clients are very conservative people and cautious, and you know, they want to come see us. They might be a client that we've done exchange work for 20 years. I haven't seen them. And also we do a retirement account. They want to come in. So I'm always happy to have people come in. Next example, builder, developer, and Ben. This is during the last crash. All these are real accounts, real transactions. So what happened, you know, dirt was literally dirt cheap. The thing was, you know, you buy it, you don't know when you're going to actually be able to build on it. And so in this situation, he wanted to land bank property with his retirement account. And that's what we did. We put a checkbook IRA together, and he went out and bought a bunch of land. He's a builder developer. So ultimately, he wanted to be able to build and develop that stuff, which he cannot do. You know, that would constitute a prohibited transaction. So what we did is we created a new limited liability company, put a bunch of vendors in there, reduced his ownership to 1/6 of it. And as a 1/6 owner, it no longer constituted a prohibited transaction. So as the property was to be built or developed, it would be moved into the development entity, built out, and then they just keep rolling through that portfolio of properties that was land banked with a retirement account. So, you know, once again, the only dumb question is the one you don't ask. This is a situation where if you look at it on the surface, it might look problematic, but we figured out a way around it. This example, a gentleman, very successful gentleman, lots of doors, apartment doors that is, tired of the terrible teas, toilets, tennis turnover, and just didn't want to deal with that stuff anymore. So, you know, his initial inquiry was about buying a mobile home RV park, which would have given us some of the same thing. The next day he called up asking about notes. And as I said, this was during the last crash. And, you know, the situation was he had an opportunity to get a note paying 11%, 50% loan to value. It was a first. And that was on a property that was like a $70,000 property pre-crash. It had been $200,000. So, you know, in his situation, he just looked at it, and man, you know, for $35,000, he's getting 11%. And, you know, if the person defaults, he ends up owning an asset that was worth $200K a couple of years early. Who wouldn't want to do that? So that investment went well. And during the time we worked with him over the, you know, coming years, he's moved several $1 million through us. And he's put it all into paper. The best investment he made, I think, in that space was a wind power farm that needed $900,000 on you know, tens of millions of dollars value, paying him 19%. And in that situation, he just was hoping that they'd default. Talk about an ultimate investment. So anyway, ask the questions. Next example, this was saving an asset. And I would, in my comments earlier about next spring, we might have some people, you know, I've got clients in 1031 space that are not getting paid rent, and, you know, they possibly are going to be in a situation where they might unfortunately lose an asset because, you know, some politicians told the tenants they don't have to pay. Well, in this situation, what happened, this was builder developer with some land, had a lien on the land, you know, had you know, a $1.4 million lien on the property, or $1.2 million, it says. Sorry about that, $1.2 million loan. And he called up asking if he could use his father's IRA to pay the property off. No, you can't do that. It's a prohibited transaction. What we did is shifted gears, created a new limited liability company. Junior contributed the property, received a membership interest attributable to his $1.8 million. And or 1.6 million, I'm sorry, $3 million property, 1.4 in lien. And meanwhile, we self-directed Dad's account, and that checkbook IRA ended up making an investment in the LLC. Now the LLC owns the asset, Junior does not, and the LLC also has the cash to pay the property off, which it did. And instead of losing the property, because that bank was also going away, it was, you know, it was horrible those times. I hope we don't go through that again, but the banks were failing, and the bank that had the loan was failing. If the bank went away, the loan goes away, the property goes away, and he lost everything. Instead, he ended up saving the asset, going vertical, turning it into an apartment complex going forward. So I really like that story. The last example, this is that one I referenced earlier with the rollover business startup. Husband, wife, retired, come to us. And I apologize, we're a few minutes over. As you know, I talk quickly, but I've still got more to get in than I've got. This is the last example, and we'll be done in a couple minutes. But in this situation, what happened, they came into us, said, look, we'd like to go buy this mobile home RV park. And they said, okay, fine, we'll do a checkbook IRA. We'll move each of your IRAs into that IRA LLC that we talked about earlier. And then the IRA LLC will make the investment. Then they mentioned, well, we'd like to actually manage, be the on-site managers, take compensation and live there. Well, none of that is possible with a checkbook IRA. All of that would constitute prohibited transactions. So instead of doing that structure, we moved it into the rollover business startup. So we took each of their IRAs, moved them into a new 401k plan, did the C Corp, the plan bought into the corporation, the corp bought the park, they got an investment, they got a job and a place to live, and I just think that is one great story. And I just think that really exhibits the power that's out there in these accounts if you're aware of what is possible. So, investors checklist. Plan ahead, takes 2 to 4 weeks to put one of these accounts together. You can purchase all types of property with an IRA, SEP IRA, Roth IRA, solo 401k, any of those accounts can be fine. You can purchase with family members and friends. You just cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You cannot use an IRA to buy a property with a mortgage, or you can use it, just got to be non-recourse. And negotiate from the deal's inception the IRA or IRA LLC's name. Do not overextend. Plan on keeping a nice cushion of reserves. Real estate is a real investment, not an alternative investment. If you're interested in more information, you can always reach out to us at IRAadvantage.net or .com. Our 1031 services are at 1031exchange.com through Equity Advantage. We've also got a property posting site, post1031.com. So if you're a broker, you're trying to get some exposure on some properties, you can go ahead and list stuff there. And there's a section on haves and wants too. Follow us on social media. If you're interested in the newsletter signups, reach out to Seymour at IRAadvantage.net. I thank you very, very much for your time today. I hope you found it helpful. If you've got questions or concerns, please don't hesitate to reach out. If you're interested in finding more for you and or your clients, please do not hesitate to reach out. All my best, happy holidays, and best of health. Thank you very much. David Moore, IRA Advantage, signing off.